we will see the financial reporting methodology for the temporal and all current method. So the temporal method takes non-monetary asset at historical rate versus monetary asset at current rate in the balance sheet, and in the income statement as well. Things go something like that. Things that are not taken average of. All gain loss enter is a cumulative adjustment in balance sheet. Or explicitly state income statement for the asset only realized. Okay? So one would make your net income fluctuate, the other would not make your net income fluctuate. Calculate the translation, evaluate the transaction, subsidiary balance sheet, income statement into parent using all current method and temporal method. All current method. Calculate the translation effect as a sum of the appreciation or depreciation of assets that were already on the balance sheet at the beginning and change in appreciation acquired disposed of. Translation goes straight into cumulative translation adjustment on the equity side of the balance sheet. Income statement is affected by the flow effect. Temporal method. Remeasurement gains or losses are calculated on monetary assets. Again, sum the gains losses from the appreciation, a change in appreciation during the year. Remeasurement gains losses enter the income statement as a remeasurement box gross profit. In addition, the income statement is affected by the flow effect. How to determine how the translation of a subsidiary will affect the financial ratios. Pure income ratios and pure balance are integral in both currencies. When income statements are mixed, distortions arise because end of the period and averages do not change at the same time. Exchange rate changes will affect the relative size of the subsidiary in the account of the parent. If the functional currency appreciates, the subsidiary will become more important. Financial rate will have larger weight on the calculation. Note the above use of all current method. Under temporal method, major differences arise because of the various historical rates used in the translation process. Describe how the temporal method versus the all current method will affect the parent company's financial ratio. The choice of translation method will have no effect on the monetary items including sales, cash flow, current asset, liability, as both methods use the current or the average rate. On the other hand, choice affects non-monetary balance income statement. Inventory FIFO under the temporal methods leads to distorted COGS, and appreciating local currency will lead to higher gross profit margin under temporal method. Depreciation or temporary appreciation is translated at different rate than the corresponding sales. Additionally, COGS and appreciable local currency will lead to higher operating profit margin in the temporal method. So in the temporal method, if the currency depreciates or gets weaker, you have COGS effect. You will have like for example, if rupee was 60 when you buy it and rupee became 70 when you sold it, so higher operating margin will be seen on just due to the currency effect. The profit margin are distorted on the temporal method. For net profit margin, this problem is aggravated by inclusion of holding gains and losses in income. The subsidiary has a net multiplication, appreciation local currency would result in profit margin. ROE is again distorted. So discuss alternative accounting method for hyperinflationary subsidiaries. The use of functional currency of the parent, consequently the carrying value of the subsidiary is neither affected by inflation nor the accompanying depreciation of the currency. The method is known as US GAAP. Translate indexed values of non-monetary asset. The idea behind the method is to separate the real and nominal effect of exchange rate. The method is advocated by IASC. The two methods are broadly similar, but there are some differences in reported income and equity. For the foreign company says it does not require reconciliation of US GAAP. Accounting bulletin. Describe the difference between IASC and US GAAP treatment of asset revaluation, pooling of interest, revaluation, pooling of asset, goodwill. So these are actually the difference between US GAAP and IFRS. Let's look at the one that are tougher to remember. So IAS allows revaluation of tangible and intangible assets. UF does not. In practical, revaluation is only likely for tangible, except that is active revaluation gains and losses go straight into equity, and IAS requires that asset revalue the entire class to be revalued. The IAS pooling of acquire can be achieved, which is rare. US GAAP has 12 tests. If they are not met, pooling must be used. In practice, pooling is more frequent under US GAAP. Goodwill. Under US GAAP, goodwill should be amortized over a period not exceeding 20 years. Under US GAAP, goodwill can be amortized over a period of 40 years. Under US GAAP, interest paid and received are classified as CFO. CFO under US GAAP, CFO. Moreover, dividends paid are received under received and paid are classified as CFO or CFF under IAS, but only CFF for dividend paid, CFO dividend received under US GAAP. IAS requires capitalization development of cost of certain criteria met. US GAAP require development cost to be expensed except for certain software development. Asset impairment. Under IAS, asset should be written down if recoverable value is below the carrying value, where the recovery is lower the selling price. Under US GAAP, an asset should be written off if the company intention to sell it and the selling price is below the carrying value, or if the company intend to keep it but undiscounted cash flow. So this asset impairment is one trickier part that we would like to look at. So in these tough areas, the one is the asset impairment. Intangible asset should be amortized over a period not exceeding 20 years. US GAAP allow 40 years. Analysis of business combination. Acquisition, goodwill, and the different methods. Let's move to the next part here. Now we'll move to the pension analysis.